Have you ever loaned someone money and wondered deep down if you'd actually get it back? Well, in the financial world, that nagging feeling, it literally has a price tag. So how exactly do we price the risk of a broken promise? When companies, or heck, even entire countries borrow money, investors don't just cross their fingers and hope for the best. No way. They demand compensation for taking on that risk. But how much is enough? How do the pros actually calculate a hard number for all that uncertainty?
Welcome to This Explainer. Today, we're opening up the ultimate toolkit. Our goal here is to build a practical, step-by-step playbook for estimating what we call default spreads across completely different types of entities. We're taking the theory straight out of the textbook and showing you exactly how risk is priced in the real world.
Here's the roadmap for our playbook. We'll start with understanding default risk, move into the bond rating system, and tackle spreads for traded bonds. Then, things get really interesting as we level up to spreads for unrated firms, assessing sovereign country risk, and finally, advanced option pricing models.
Okay, let's jump right in with Section 1, Understanding Default Risk, the foundation of pricing debt.
Because the truth is, every investment has value, right? But before we can calculate that value, we absolutely have to quantify the risk of simply not getting paid. So, understanding this definition is absolutely crucial. The default spread is just the premium demanded by investors over a riskless rate to compensate for the likelihood that promised cash flows might not be delivered. Think of it like this. If a perfectly safe U.S. Treasury bond pays, say, 3%, and a corporation wants to borrow your money, well, they have to pay you that 3% baseline, plus a little extra to cover the chance they might go bankrupt. That little extra? That's the default spread. It's the literal cost of their risk. And, tracking default spreads over 4 decades reveals these massive, completely unpredictable spikes. Spreads are definitely not static numbers you just look up once in a textbook and forget about. Historically, they widen significantly during recessions, and then they shrink right back down during economic booms. When the economy slows down, investors get nervous and they demand a much higher premium for the exact same borrower. The big takeaway here is that default spreads have to be re-estimated regularly so they reflect the current pulse of the market.
Which brings us to Section 2, the bond rating system, or as I like to call it, the language of risk.
To measure this risk consistently, the market relies heavily on independent agencies like Standard & Poor's and Moody's, and there is a sheer rigor behind getting a simple letter grade from Standard & Poor's. It involves deep research, meetings with the issuer, committee votes, and even a whole appeals process. It's kind of like your personal credit score, but on a massive corporate scale. They assign letter ratings where AAA represents the absolute highest rating with the lowest default risk, and as the risk goes up, the ratings decline all the way down toward D, which literally stands for default. Generally, anything BBB or above is considered investment grade, meaning it's relatively safe.
All right, let's move to Section 3, Spreads for Traded Bonds. This is Level 1, Liquid Markets.
Here, we're dealing with companies operating in highly liquid markets. From massive companies like AT&T or Boeing that have widely traded bonds, estimating their cost of debt is actually pretty straightforward. A AAA-rated firm might only pay a tiny 0.5% spread over the Treasury rate, but drop down to a highly risky CCC rating, and wow, that spread skyrockets to 8%. So how do we actually get these numbers? Well, we find a sampling of liquid bonds in a specific ratings class, average out their market interest rates, and compare them to the matching Treasury rate. We use a sample rather than just one single bond, because sometimes the market misprices a bond. Averaging just smooths out those errors.
But wait, there's a catch here. Usually, the maturity of the bond matters immensely. Normally, the longer you lend your money, the wider the default spread is going to be, simply because there's more time for things to go wrong, right? But interestingly enough, in January 2011, there was almost no perceptible pattern to default spreads over maturity. It was wild. The 10-year spread wasn't noticeably larger than the 1-year spread. Why does this matter to us? Because it reminds us that while rules of thumb are great, we always have to look at the current market data. The market's perception of long-term versus short-term risk can occasionally just flatten out entirely.
Now we're leveling up to Section 4, Spreads for Unrated Firms. Level 2, the Private Firm Hack.
So what happens when a smaller company or a private business doesn't have public bonds or a fancy S&P rating? We have to pivot our whole methodology. We can't just look up a public market price using a bond's yield to maturity anymore. Instead, we've got to get creative. We basically have 2 main hacks. The first is super simple. Just look at their recent borrowing history. If they took out a bank loan last month, that interest rate gives us a great real-time snapshot of the default spread lenders are charging them. But if we don't have access to that, we have to build what's called a synthetic rating. Let's see how this actually builds. We can literally play the role of our very own ratings agency by following 3 highly actionable steps. Step 1. Calculate the firm's interest coverage ratio. That's just their operating income divided by their interest expenses. Easy enough. Step 2. We take that ratio and match it against a table of average ratios for S&P ratings classes. And finally, step 3. Once we assign them that synthetic rating, we just look up the typical default spread for that rating in the current market, and boom! Just like that, we've priced the risk for a totally unrated private company.
Ready for the hard level? Let's dive into Section 5, Assessing Sovereign Country Risk. Level 3, Global Complexity.
When you value a company in an emerging market, you aren't just pricing the company's risk, you are pricing the risk of the entire country they operate in. We have 3 primary tools for estimating these sovereign risk premiums. We can use sovereign ratings provided by agencies, we can look at the credit default swap or CDS market, or we can use a fundamentals-based build-up approach. Let's quickly unpack the pros and cons of each of these.
First up, we have sovereign ratings. Agencies like Moody's rate countries just like they rate companies, and we can find the spread on their dollar-denominated bonds. The problem? Ratings agencies often lag behind the markets. They can be pretty slow to update when a country's situation is rapidly deteriorating. On the flip side, we have the CDS market. Credit default swaps provide a dynamic, daily market measure of a country's default risk. However, because it's traded daily, it can be extremely volatile. You really have to choose between stability that might be slightly outdated or accuracy that bounces around every single day.
But what if a country doesn't even issue local currency bonds? Well, that's where the build-up approach comes in. It is brilliantly simple. To find the risk-free rate in any currency, we just add 2 things together: the expected inflation rate in that country, plus the expected real rate. And we can usually proxy that real rate using an inflation-indexed U.S. Treasury bond. So if expected inflation in India is, say, 6%, and the real rate is 1%, your built-up base rate is 7%. From there, you can just start layering on your risk premiums.
Finally, we reach Section 6, Advanced Option Pricing Models, the climax.
This is where we bring in the heavy mathematical machinery. Up until now, we've used market prices and historical ratings, but there are commercial services out there that use fairly sophisticated option pricing models to estimate these values. What this means is that we can apply complex math to bank loan portfolios to extract the exact risk-neutral probability of default. It allows a lender to look at a firm's volatility and mathematically verify, is the interest rate I'm charging today actually high enough to cover the statistical probability this company goes bankrupt tomorrow? It's risk pricing turned into an absolute pure science.
So we've built an incredible playbook today, from checking public bond ratings to hacking synthetic ratings for private firms to pricing the stability of entire nations and even using advanced option models. But I want to leave you with a provocative thought based on everything we've covered. We can calculate ratios, track CDS markets, and run all the advanced probability models we want. But at the end of the day, companies and countries are run by people. So can mathematical models ever truly predict the complexities of human default? Something to think about the next time you price a broken promise. Thanks for joining me on this explainer.